Hello, beautiful people, and welcome to this week's edition of the ITU Forex class. In this week's class, we're going to be talking about the hidden divergence, which is actually we want to build upon what we learned in last week's class, which is talking about the regular divergences. Okay, so if you could remember from the previous class, what I made you understand was that divergence is a phenomenon which occurs in the market where price is doing a completely different thing than what the oscillator category of technical indicators are doing. So to kind of make it clear for those who are just joining us for this week's edition, in an ideal situation, in an ideal market situation, what you want to see on the price chart is for price to be doing one thing. For example, if price is in an uptrend, you want to see price forming higher highs and higher lows, because this is the structure of an uptrending market. And you also want to see the oscillator, okay, in its little window below the price chart doing the same thing. So when price makes a higher high, you also want to see the oscillator making a higher high. And when price makes a higher low, you also want to see the oscillator making a higher low. Okay, so basically the oscillator is almost as if it's mimicking what price is doing on the charts. Okay, but there comes a point in time where even though the price and the oscillator would agree with each other for some time, there comes a point in time where if momentum is diminishing in the market, price is going to do one thing and the oscillator is going to do a different thing, an entirely different thing. So let me show you an example here. Okay, so let's say, like I gave you the example earlier on, that price is forming higher highs and higher lows. To illustrate this on the charts, let's use this as an example, okay? Let's say this is the structure of an uptrending market, okay? So let's say price starts its move from this origin point. And when it begins that move, okay? When it begins that move, it starts forming this higher highs and higher lows here, okay? And then all of a sudden, okay, my drawing is not appearing on the chart, so let me see if... very good. It's now appearing on the charts. So let me delete this and redraw it again. So let's say price starts its move from this origin point and then it pulls back, okay, to this origin point, because in a healthy uptrending market, you don't want to see price going all the way down to the higher low where it began its move from or whatever, okay? So you want to see price forming a higher low. And you want to see price in a healthy uptrend breaking above the previous highs to form a higher high. Okay, so let's say this is a typical example of an uptrending market. This is the structure of a typical uptrending market. Now, what you want to see in the oscillator window is that the oscillator is doing the exact same thing that price is doing. So since price formed higher highs and higher lows here, you also want to see the oscillator beginning from somewhere around here and then going all the way up when price forms a higher high, then pulling back a little bit, and then going all the way up again to form a brand new high, also higher than its previous high, the same thing, okay? So you want to see price and oscillator doing the same thing. But then this doesn't always happen because the oscillator group of technical indicators are designed to measure momentum in the markets. So to put it in simple terms for you, okay? Let's assume that this move that occurred, this move where price started to move from all the way down here, okay, so where price began its move from all the way down here, to all the way up here, okay? Let's say this move took price something like 10 candlesticks. So you had something like 10 candlesticks. Okay, this drawing of a candlestick is something else. Let me redo it. Let me quickly take this off because that's embarrassing. So let's say we have something like this. Let me use this to illustrate my point. Let's say we have 10 candlesticks, okay? Okay, this is also customized here. I think I would have to use this rectangle tool here, okay, to illustrate my point. I mean, you get it. We have 10 candlesticks that formed this move that went from all the way down here to all the way up here. The way the oscillator group of technical indicators are designed to work is that if it takes this move, 10 candlesticks, to move all the way from all the way down here to all the way up here, and let's say this move, if you measure it in pips, is like 100 pips. And since, let's just use an example that's easy to understand. Let's say you're using the 1 hour time frame. Okay, so if it takes this move 10 candles, that's like 10 hours to go from here to here. That's 100 pips. Okay, 100 pips. So if it takes it 10 candles, this would mean that that 100 pip move that occurred from this point to this point, it took it 10 hours, since we're using the 1 hour time frame as an example. Now, the oscillator is going to record this move, and it's going to record the momentum, the momentum it took, okay, for this 100 pip move to occur on the charts. Now, let's say, for example, you've got this same, another move, because price just moved from all the way down here to all the way up here. And since we're using an uptrend as an example, when price pulls back and then it resumes that trend to form a move that will break above this previous high. Let's say this move is also something like 100 pips, or maybe even 120 pips. But in this second instance, this impulse leg, because it's an impulse leg, because we're using an uptrend as an example, and this move is a move which advances the uptrend. So it's an impulse move, while the move which moves in the opposite direction of the trend is called a corrective move. Okay, so in this particular example, let's say that the second leg of this uptrend, this impulse move, is 120 pips, but instead of occurring in 10 hours, this move actually occurred in something like 8 hours, for example. So you see, it took this move 10 hours, because we said 10 candlesticks, to move from all the way down here to all the way up here, which is a distance of like 100 pips. And then this second move, which is the new higher high which was formed, it took it less time to move even further than this particular move occurred. So because of this, the way oscillators are designed is they're going to make a higher high than the previous high they formed, because the assumption is that if it took this move 10 candles, 10 hours to make a 100 pip move, but then it took this particular move only 8 hours to form a move which is even further than this one, because this second move is like 120 pips, then there's more momentum in this move than we had in the previous move. But then, like I keep telling you, that even when the market is trending, even when that trend is strong, price does not move in a straight line. It's usually going to move a little bit, then it will pull back and then continue moving in the direction of the trend. It will keep doing this until the momentum begins to die off. And then let's say, for example, the time the momentum for this particular move begins to die off is when you see that price made a move which is like 80 pips, for example. So it moved from all the way here, which is our new higher low, to form a new higher high. Let's say it barely formed a new higher high. Okay, or to make this example a little clearer for you, because this is clearly a very strong big higher high. So let me, to not confuse you, let's say that price now moved from this higher high, okay, because this particular higher low, this particular low is higher than this previous low. So let's say price continued to move, but then it's trying to continue to move in the direction of the trend, but it just barely breaks above this previous high, because the momentum is beginning to die off now, and then it pulls back, okay? And this pullback, obviously, let's say, it pulls back to this higher low, it breaks below it slightly, and then it pulls back, fails to form a new high, and then you know what happens, okay? But for just this example, let's just focus on this particular move, okay? So in this case, let's say now, price moved from this higher low to barely breaking above this previous higher high. And then the distance of this particular move is, let's say, something like 70 pips. But then, even though this move is only 70 pips, remember, the first example I showed you is that price moved from all the way down here to all the way up here, which is like a 100 pip move for this particular example. But this move occurred in 10 hours, okay? And this second move was obviously bigger than this previous move, but it occurred in shorter time, which is the reason why the oscillator formed a higher high. But then let's say this particular move that occurred, price just moved 80 pips, or 70 pips, like I told you. But then this particular move, it took price 12 hours to form this move. So not only did it not move like the previous impulse wave, but it also took longer to make this move. Now, by the way that the oscillators are designed to work, this would indicate that there's a winding down or dying off of momentum in the market for this particular bullish trend. And as a result of this, the oscillator now, okay, let me pick this ink tool. So the oscillator now is not going to be able to form a higher high, because as you can see, obviously messed this up. Because as you can see, price just barely broke above this previous higher high, and it took longer to form this higher high, which barely broke above this resistance, and it also moved a lot less in the number of pips than the previous impulse waves. So because of this, this is going to be drawn as a lower high on the oscillator's window, and this is what is. This is when we'll see a phenomenon known as regular divergence being drawn on the chart. Because ideally, the way the oscillator and price is supposed to work is that when price forms a higher high, the oscillator should also form a higher high. And when price forms a higher low, the oscillator should also form a lower low in case of an uptrending market. It's supposed to be doing the exact same thing that price is doing. But when it fails to do that because of dying momentum in the market, that's when we see that there's divergence in the market, and that's when we act. So like I told you, in last week's class, we said that the regular divergences, they usually occur when there's about to be a turning point in the market. So if price was in an uptrend, and then uptrend or downtrend or whatever trend it is that you have in the market, like I keep telling you, they don't last forever. There's always going to come a point in time where the momentum behind that particular trend is going to start dying off, and then price is either going to reverse or consolidate, but the trend is not going to continue indefinitely. Okay, so regular divergences are used to identify reversals in the market, potential reversals in the market of a trend. But hidden divergences, which is what we're going to be talking about today, they are not meant to be used for identifying turning points in the market, but rather they are meant to be used to identify where there is likely going to be a continuation of the trend in the market because of dying momentum for the corrective waves which occur in the price move. So to help you understand this better, let's quickly go to my whiteboard, okay? So let me quickly go to the whiteboard, okay? And we're going to start this explanation, okay? So moving on. The drawing you're seeing on my chart here is an illustration of an uptrending market, okay? So this particular thing that you're seeing here is the price chart. So price made a low here, and then it moved from all the way down here to form this high. But then, like I keep telling you, in an uptrending market, price does not move in a straight line. It's going to move up, then it will pull back a bit. Then it will pull back, and then it will move up and break the previous high that it couldn't break earlier on to form a brand new higher high. But then it will pull back a little bit to form a low, which is higher than the previous low, which will lead to the formation of higher highs and higher lows, okay? So this is a low, but it's HL here because it's higher than the previous low, and that's why this is called a higher low. And this is a high, but this new high is, we're going to write HH here because it's a higher high because it's higher than this previous high. And then this low is higher than the previous low. Okay, this is a regular thing. This is the anatomy of an uptrending market structure here. Higher highs, higher lows, higher highs, and higher lows. Now, if you've been following me, you know that I told you that oscillators and price are supposed to be doing the same thing. So when price forms a low, the oscillator is also supposed to start moving from that low. And then when price forms a high, the oscillator also should form a high in its little window, which is below the price chart. That's usually where you see your RSI, your stochastic oscillators, the MACD, and all of those indicators, okay? Now, when price forms a higher low, the oscillator is also expected to form a higher low because on a regular, you want price and the oscillator to be in agreement with each other. You want them to be doing the same thing. When price forms a low, the oscillator forms a low. When price forms a high, the oscillator should also form a high, okay? But then, when price forms a higher high, just like we have on the chart somewhere around here, the oscillator, we're also expecting it to form a higher high. But then, what you'd noticed here is that this higher high, this higher low, and this higher low, obviously on the price chart, this higher low is higher than this higher low because it's way up here and this higher low is way down here. But then when you see the oscillator form a higher low just like we had here, meaning price from the higher low here and the oscillator form that higher low, but then when price forms a higher low which is higher than the previous low, the oscillator goes on to form a lower low. This is telling you that there's a hidden divergence on the chart because price and the oscillator are not in agreement. Now I need you to understand this. This is very important. When you connect these 2 points, what you'd have here is a upward sloping line for an uptrending market, okay? This is a hidden bullish divergence. Okay, why is this a hidden bullish divergence? My spelling here, so excuse me for the triple L here. It's supposed to be double and then one I, obviously. And then this is supposed to be a downward sloping line. For a hidden divergence to occur on the chart, you need price to be forming higher highs and higher lows, but then the oscillator at some point will form a higher low and then a lower low because price will be sloping upwards, but then the oscillator will be sloping downwards. This is what a hidden bullish divergence looks like. But then for a hidden bearish divergence, it's the complete opposite. For a bearish divergence, hidden divergence, you would have price doing the normal regular thing it does, which is forming lower lows and lower highs. Lower lows and lower highs. Okay, so if we were to label this, we would have this from all the way up here, meaning we have this high and we have this low. This high was our origin point, okay, and then we have this low. But then all of a sudden, price forms a high which is lower than the previous high. That's why we are calling this LH, lower high. And then price forms a low which is lower than the previous low, and this is called our lower low. And then this high is lower than this previous high, and that's why we have lower high. And this low is lower than the previous low, which is a lower low. Okay, so this is regular. This is normally what we would see in a downtrending market. This is the market structure of a downtrending market. Now, if there was an oscillator below this chart, what it would look like will be for price to start moving from all the way up here, okay, because price was having a high here, and the oscillator is supposed to be doing what price is doing. So it will move from its high, just like price moved from its high, to form a low here. Okay? And then when price formed this lower high, it is expected that the oscillator should also pull back and then form a lower high. And then when price formed this lower low, it is expected that the oscillator should also form a lower low. But then when price formed this lower high, instead of the oscillator to also form a lower high, it will go all the way up to form a high which is higher than this previous lower high. So this would be a higher high. And then when price forms this low, then it will also move down to form this low. So if you connect these 2 points on the oscillator, which form this lower high and this higher high, okay, and you connect these 2 points on the price chart, which forms this lower high and lower low, lower high and lower high, these two ones, you would have a downward sloping line on the price chart and an upward sloping line on the RSI or the stochastics oscillator or any of the oscillators that you're using, which is simply showing you a hidden bearish divergence in this case. Okay, so basically what hidden bearish divergences do is they show you the potential in a market for it to continue moving in the direction of the established trend. On the other hand, what we covered last week is regular bearish divergences, which show you potential for reversal. Again, hidden divergences show you the possibility of a continuation of the trend in the market. So if the market is in an uptrend, when you see a hidden bullish divergence, it is expected that price is going to continue that moving in the direction of that uptrend. But when the market is in a downtrend and you see a hidden bearish divergence, you are expecting price to continue moving in the direction of that downtrend. On the other hand, when you see a regular bullish divergence, that is an indication that price is going to reverse, okay, to the opposite side of the trend which was established in the market. So if the market was in an uptrend and then you see a regular bullish divergence, you are expecting that price is going to move to the downside to reverse that uptrend that it was doing, because trends don't continue forever. And then it will start moving, either consolidating or reverse altogether to start moving to the downside. And if the market was already in a downtrend, and then you see a regular bullish divergence, the assumption is that price is going to reverse from moving in the bearish direction to either consolidating or moving to the bullish direction. Okay, so that's their two distinct differences. Okay, so let me quickly show you, we've gone over the theory. Let me quickly show you exactly what this looks like in action using the live price charts and an example for you. Okay, so as you can see on my chart here, what we have on the screen is a hidden bearish divergence. Okay, why do I say we have here a bearish hidden divergence? Well, when you look at this price chart, what you would notice is that price went from forming higher highs and higher lows, okay, to all of a sudden price just reversing altogether and then starting to do the market structure, or starting to form the market structure or print the market structure of a downtrending market. Okay, so instead of price forming the higher highs and higher lows, which it has been doing all through this move, price now all of a sudden just went to now start forming, okay, lows and lower highs, lower lows, lower highs, lower lows, and lower highs. Now, ideally, what we want to see on the charts, is if price is forming lower lows and lower highs, what do we want to see the oscillator also doing? If you remember from the theory aspect, which we've just covered, we also want to see the oscillator forming lower lows and lower highs, lower lows and lower highs. But as you can see from the charts here, you can see that when price was forming these lower lows and lower highs, all of a sudden the oscillator formed this low, which is this lower high. Okay, it moved from this high to form this lower low, and then pull back to form this lower high, and then the oscillator, price from this lower high, and then the oscillator from this lower high also. But then when price formed this lower low, the oscillator formed another lower low. But then when price formed a low which is lower than this previous higher low, the oscillator instead formed a high which is higher than this previous lower high. So we've got a divergence here. Instead of the oscillator doing what price did to form a lower low, it is slanting all the way upward when you connect its 2 points here, just like we have here. Okay, and this is where we saw that we had a bearish divergence in the market. Now, what did I tell you about bearish divergences? When you spot a bearish divergence on the charts, if the market was, obviously it's called the bearish hidden divergence because the market was in a downtrend. So when you spot this hidden divergence, it is showing you that obviously price is likely to continue moving in the direction of the trend that is prevalent in the market. So since the market was in a downtrend, when you spotted this hidden divergence, then the assumption is that price is going to continue moving in the direction of that downtrend. Okay, now there are two ways that traders, just like I keep telling you guys in most of the classes that we've done, there's no one way or no one size fits all in trading. There are different ways that different traders take advantage of different trading setups in the market. So for example, if you've got a divergence, for example, it could be a hidden divergence, it could be a regular divergence, or whatever the case might be, whatever type of mechanism you're using to trade, there is an aggressive way to take trades with it, and there's also a conservative way of taking trades with it. Now, for the aggressive way, a trader who is trading hidden divergences or regular divergences or whatever the case might be, and he's trading with the aggressive method, as soon as he spots his divergence on the chart, he's not going to wait for anything. When he sees something like this type of hammer candlestick here, or this big bearish engulfing candlestick, he will quickly enter into the market with the trade setup, place his stop loss ideally above the high where the bearish divergence started. Why? Because the idea is that if price was for whatever reason going to go above and break this high, we no longer have a bearish divergence in the market. So some traders will just, as soon as they see the divergence, they will enter a trade, place their stop loss above the highs, and go for a maybe fixed risk to reward ratio exit. So if they are risking 100 pips, they might be aiming for 1:2 or 1:3. So if they're aiming for 1:2, meaning they're risking 1% of their account capital in order to make 2% or 3%, they are going to be aiming for a 200 pips profit or a 300 pips profit. And obviously, as you can see, if this particular trader took the trade here with a stop loss above here and went for 1:2 or 1:3, he would have obviously made a profit on this trade, maybe even hit his profit target. But then there is also the conservative group of traders. So Who are the conservative group of traders? The conservative group of traders are those traders who, after they spot the setup, they don't just rush to enter into the market with their trade. They wait for market structure to agree to confirm what they've already seen on the chart. So, for example, the conservative trader, when he spots that we have a hidden divergence on the chart, just like we've identified here, instead of him just entering into the market already here and placing a stop loss here, he would wait for price to then come down and form a lower high. Why? Because if truly this is a hidden divergence and truly the market wants to continue to move in the downtrend, then the market should have no reason whatsoever to break above this lower high. And so when he sees that price forms this move and then it pulls back, but then that pullback doesn't have enough momentum in it to break above these highs, okay, which we use to draw our hidden divergence, that will be his cue. After he spots maybe a hammer candlestick or a bearish engulfing candlestick or anything like that, after he sees this, he's going to be like, okay, yes, we've spotted a hidden divergence, bearish divergence in this case, and also price, the market structure in the market is showing me that price is finding it difficult to break above this resistance. And so since divergence is our first setup, our first indication, and then we also have the confirmation of market structure, now I am comfortable taking this trade. And so he will take the trade here and then place his stop loss above here, above the levels or the lower highs which we use to identify the hidden bearish divergence, and then go for a fixed exit like 1:2 or 1:3. Now, does this mean that because the conservative trader is waiting for more confirmations that he will have more wins or whatever? Yes, it technically it works like that, but there's also a caveat. Because the aggressive trader is entering a lot earlier, most times his stop loss will be very small. So maybe 50 pips or at most maybe 100 pips, depending on the pair he's trading. So if he's going for this and he's going for, maybe market structure for his exit, he might have a higher risk to reward ratio. So even though his win rate might be very, very low compared to the conservative trader, because he might be going for a higher risk to reward ratio, like risking 1 to make 3 or 4 or whatever the case might be, he would end up making much more profits. But the conservative trader, because he's waiting for the moves, to confirm before he takes the trade, most often his stop loss is going to be a little bit wider, and so his profit target will be affected also. So he might have on average risk to reward ratios of something like 1:2 or whatever, but then even though his win rate is a little bit higher than the aggressive trader, he would still end up making a little less profit because his risk to reward ratio is not that high. But this is the part of the class where I don't tell you be the aggressive trader or be the conservative trader, okay? Because you need to do a self-assessment. Are you that type of trader who, if you take like 5 or 6 or 10 losing trades in a row, not that it's going to happen often, but you also need to know that it's possible. Because this is trading, okay? Just like if you hear any guru or any trader telling you that you're not going to have losing trades or whatever, they're just lying to you. You need to accept the fact that you're going to have losses and then prepare for them accordingly, okay? So you need to have that self-assessment. If you encounter 3 losing trades in a row or 5 losing trades in a row, will it affect your ability to identify setups in the market? If your answer is a yes, then my advice to you would be to forget about going for the aggressive method and going for higher risk to reward ratios. Even though you're going to make more profits, because it's going to mess with your psychology, it's going to mess with your head, those consecutive losses, those losing streak, it is not worth it for you. Go for the conservative method. The conservative method, does this mean that you're not going to have losing trades? Of course not. Even though I trade conservatively, my win rate is not even up to 50%. It's like 40 or something percent, and I've made a lot of money with that, okay? You don't need to win every time. You don't need to win even 50% of the time to make profits. As long as you're trading with good risk to reward ratios, with proper risk management, even if you only won like 40% or 30% of the time, you'd still end up on top. So if you're a trader who wants to trade with, you don't want to have those mega losing streaks in a row, then the conservative approach might be for you. You need to assess yourself and then make an informed decision, a plan which fits your trading personality. Okay? And this is the point of the class where we're going to talk about the ITU bots, okay? Which is the suite of technical expert advisors which are designed to trade for you automatically. Like I keep telling you, these classes, the ITU Forex classes, are meant to teach you how to trade manually, how to improve your trading skills using manual trading techniques. But we also have a portion of the company which is aimed at helping you to assign or allocate a portion of your portfolio to automated trading with bots which are designed to trade for you, identify setups for you, do risk management for everything on autopilot. Okay, we have step-by-step guides which will help you to set them up once you get into the academy and all of that, and get them making money for you on autopilot, okay, with proper risk management and all of that. So if you're interested in it, please reach out to us on our socials, or just leave a comment in the comment section. I will be glad to help you out, set everything up, and walk you through everything you need to set them up. So if you have any questions, feel free to reach out to us about it, and we'll gladly walk you through how to set things up. So once again, thank you for attending this week's edition of the IT Forex class, and I look forward to seeing you in next week's edition, where, as usual, we're going to be giving you gems and tips and tricks which are designed to help you become a much better profitable trader. Okay, so I look forward to seeing you guys in next week's edition. Have a wonderful rest of your week, and God bless you all. Cheers.